When the stock market goes down, most people lose money. However, you can make a lot of money instead of losing it if you have the appropriate attitude and approach to investing. You may think I'm insane for stating this, but we're going to show you that Peter Lynch holds the same opinion. Let us explain. The annual average return of 29.2% earned by Peter Lynch is higher than Warren Buffett's. Welcome to the Investing Wise Academy, a channel where aspiring millionaires and billionaires can learn how to invest wisely. In this video, we're going to show you an old interview on what Peter Lynch says about stock market crashes. If you're new to our channel, please subscribe to see more videos like this. Let's get started.
Are you concerned about the volatility in the financial markets today? Do you think something needs to be done to reduce it?
I love volatility. I remember when in 1972 the market went from down dramatically, and Taco Bell went from 14 to 1. They had no debt. They never had a restaurant close, and I started buying at 7, but I kept on to it, and it went to 1. And it was the largest position in Magellan in 1978 when it was bought out by $42 by Pepsi-Cola, and I think it would have gone to 400 if they didn't buy it out. I think volatility is terrific. I think these callers are very important. I don't think the market going up 80 points one day and down 80 the next is a good thing for the public. I think that's not a very good thing. But I think all of these callers and all these other things, to keep the volatility down each day is important. But the market's going to go up and down. Human nature hasn't changed a lot in 25,000 years. And some event will come out of left field, and the market will go down or the market will go up. So volatility will occur, and markets will continue to have these ups and downs. I think that's a great opportunity if people can understand what they own. If they don't understand what they own, they can own mutual funds, try and figure out mutual funds they own, and keep adding to it. Basically, corporate profits have grown about 8% a year historically. So corporate profits double about every 9 years. The stock market ought to double about every 9 years. So I think the next market's about 3,800 today, 3,700. I'm pretty convinced the next 3,800 points will be up. It won't be down. The next 500 points, the next 600 points, I don't know which way they're going. So the market ought to double in the next 8 or 9 years. It ought to double again in the 8 or 9 years after that. Because profits will go up 8% a year, and stocks will follow. That's all there is to it. But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine. And you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own.
As you are well aware, we are currently experiencing a stock market crash. Stocks are down more than 20%, and we're in the midst of panic. But more importantly, what are we going to do about it? So there are 3 significant lessons from this video that we'd want you to highlight. The first is that long-term stocks will increase in value because at the end of the day, a stock is a component of business, and business's primary purpose is to produce money. Do you think businesses will make more or less money in 3, 5, or 10 years? Of course, they'll produce more. According to Peter Lynch, corporate earnings grow at annual pace of roughly 8%. As a result of compounding, they should double every 9 years, implying that the stock market should also double every 9 years. To fully grasp the second principle, you must first grasp the first. As a second rule of thumb, you want to buy stocks when they're at their lowest price points, during the peak of the crash, because the cost of living will continue to rise in the long run. When would you want to buy it? When is the best time? Well, at the bottom, of course, a market crash is good for us investors, as Peter Lynch said. I love volatility. This brings up to the third principle from the video, which is to buy enterprises of high quality. Consider some examples he provided in the clip. Taco Bell. It was a terrific business then. With no debt and no restaurants closing, Lynch was confident that it will rise in the long run. He also referred to Coca-Cola. Because it was a high-quality enterprise, it was inevitable that it would rise in value over time. Nevertheless, this gets us to one of the most critical investing principle, and we'll let Peter Lynch explain it.
I made 10 or 15 times my money in Dunkin' Donuts. Those are the kind of stocks I can understand. If you don't understand it, it doesn't work. This is the single biggest principle. And it bothers me that people are very careful with their money. The public, when they buy a refrigerator, they get a Consumer Reports, they buy a microwave oven, they do that. They ask people what's the best kind of radar range, or what kind of car to buy. They do research on apartments. When they go on a trip to Wyoming, they get the Mobile Travel Guide, or California. When they go to Europe, they get the Michelin Travel Guide. People will hear a tip on a bus on some stock, and they'll put half their life savings in it before sunset, and they wonder why they lose money in the stock market. And when they lose money, they blame it on the institutions and program trading. That is garbage. They didn't do any research. They bought a piece of junk. They didn't look at the balance sheet, and that's what you get for it. And that's what we were being driven to, and it's self-fulfilling. The public does terrible investing, and they say they don't have a chance. It's because that's the way they're acting. I'm trying to convince people there is a method. There are reasons for stocks that go up. Coca-Cola, this is very magic. It's a very magic number. Easy to remember. Coca-Cola is earning 30 times per share what they did 32 years ago. The stock has gone up 30-fold. Bethlehem Steel is earning less than they did 30 years ago. The stock is half its price of 30 years ago. Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. It's not that complicated. People get too carried away. And first of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market. They try to predict interest rates. I mean, if anybody would predict interest rates right 3 times in a row, they'd be a billionaire. Considering there's not that many billionaires on the planet, it's very, I had logics, I had a syllogism and studied these when I was at Boston College. There can't be that many people who can predict interest rates because there'd be lots of billionaires.
No one will be able to foresee the short-term behavior of the stock markets. It's not just feasible. They maybe succeed once or twice if they're lucky, but they can do it consistently or they can't be filthy rich. However, we do know that over the long term, the stock market will rise, which is why it is imperative that we begin investing for the long term when equities are low and inexpensive. However, according to Lynch, this must be in companies that we understand. We must invest time and energy in mastering the balance sheet, the income statement, analyzing profits, comparing asset price, and all other fundamentals. If you don't go through them, you'll probably end up the bottom. Peter Lynch also advised that you should be familiar with history. So, looking back 75 years give us a good sense of how market works. When prices are low, the points, the heights, and the midst of crashes are often the finest times to invest in the stock markets, not necessarily when everything is fine and dandy, since things are most expensive and it's honestly fairly basic. This reminds us of a quote from Warren Buffett. He said this when he was asked for his best investment advice: "When an individual with cash meets an experienced individual, that individual with experience ends up with a cash, and that individual with cash leaves with experience." This just goes to show how vital it is to have knowledge and experience in your field of expertise, because there are only 2 methods to obtain these things. 1, by living to 67 years old and investing and learning along the way, or 2, by learning from the experience of others such as Peter Lynch and Warren Buffett. And that's what we are attempting to do in this video, getting you to learn things from the experience of others and what the key things that they were saying. 1, a crash is a good thing for a smart investor. 2, you should be buying stocks during market crashes. 3, don't just buy any stocks. And finally, make sure you understand the company before investing. These are the essentials. That's all for today. What are your thoughts on Peter Lynch's advice about stock market crashes? Join the conversation in the comment section below. Please click the like and subscribe buttons if you enjoyed the video. We'll see you in the next one.